$100 million, one single trade, one trader. If you are a scalper, day trader or long-term trader, you must heard about Jesse Livermore. This legendary trader is the most successful short seller in the history of the US. For the past 9 months, I tried to study this guy, what's special about him, trying to understand his trading style, what was his prediction based on, and finally, I was able to unravel his secret, and believe it or not, it all comes down to these 10 principles. 10 principles that we are going to draw on the circle that he disciplined himself to follow every time he took a trade. Now, are you ready to dive deep with me into the genius of Jesse Livermore?
The most important thing when swing trading is the trend is your friend.
You can make a heap of money with a 50% system.
Patterns are probably the most powerful technical analysis tool.
Everyone can do it. It's easy, and you can make $10,000 a month trading the international Forex markets.
I don't mean that these guys are wrong, but let's be honest. Aren't you just tired of those YouTube tutorials that will give you only short-term advices that are so obvious? Apply this strategy, use this indicator, follow this signal, trade on this platform, read this book, use this method. Don't get me wrong, but if you have decent knowledge and enough experience in trading, you already know that these advices are useless if you are aiming for a long-term trading career, and the only way to be the best is by studying the best. The first principle I learned by studying Jesse Livermore is that you must decide on one type of trading only. Don't confuse yourself. At the beginning of your trading career, you must choose one. Binary option trading, Forex, stock trading, or crypto trading, because you need to focus on one domain only. Choosing the type of trading that suits your best involves considering various factors, including your goals, risk tolerance, time commitment, and personal preferences. To choose the type of trading that suits you best, you need to look at different factors. The first one is that you need to understand each market. So, learn about the characteristics, pros and cons of different markets. Cryptocurrency trading, Forex trading, binary options, and stock trading have unique features. So, understanding how each market operates will help you make a better decision. The second factor is that you need to define your goals. Clarify your goals. Are you looking for short-term gains or long-term investment growth? So different markets may be better suited to specific goals. For example, day trading is common in Forex and cryptocurrency markets, while stock trading may align with more long-term investment approach. Also, assess your risk tolerance. You must evaluate your risk tolerance because some markets like cryptocurrencies and binary options can be highly volatile, leading to the potential for significant gains, but also may cause a lot of losses. So if you are not ready for the risk, you may prefer more stable markets like stocks and the traditional Forex pairs. Also, you better consider time commitment, because different type of trading require varying levels of time commitment. Day trading and scalping demand constant attention, and believe me, this is frustrating, while long-term investment doesn't need you to keep checking your portfolio all the time. Alright, now after you decided what type of trading you chose and what style of trading suits you best, the next thing you want to do is educate yourself. Until now, you already know the basics of different trading styles, the major differences between different markets and different trading types. So next, you must jump to more technical stuff. You must have a basic understanding of all the trading principles, how to read the price chart, what short positions means, how does short positions works, what long positions means, how does long positions works, how to read a candlestick, what is an uptrend, what is a downtrend, market reversals, consolidations, dips, pumps. Alright, after you mastered the basics of trading, then you must jump to the next level, which is more complicated stuff like technical analysis and fundamental analysis. In this part, you must know how to read the chart more deeply and more technically. You must know how to draw resistance lines, support lines, trend lines, and pivot points. And also learn how to use technical tools like Fibonacci retracement, Fib channels, time zones, circles, spirals, pitch fans, and more. When we talk about technical analysis, we are mostly talking about technical indicators. Technical indicators are a set of tools that collect data from the chart to help you understand the future direction of the market more. So there is thousands and thousands of different indicators, but you must focus on only the most popular ones like moving averages, Bollinger Bands, Parabolic SAR, MACD, RSI, exponential moving averages, super trend, stochastic RSI, volume oscillator, envelope, momentum, and price oscillator. I believe that these indicators are enough for you to master a proper technical analysis. The next rule I learned after studying Jesse Livermore is how special his risk management was. As a trader, you must be wise with that penny you are investing, because once you lose it, it's gone forever. You will never recover. You may make thousands and thousands of dollars, but that penny is gone forever. Risk management should be an essential part of your trading strategy. Learn the basics of risk management and how to apply it to your trading plan. In my beginnings, I wasn't focusing on my risk management. Yeah, I was making decent money in the short term, but in the long term, the opposite was happening. I was using good strategies, doing my research, backtesting, everything was perfect, but somehow there was no profit. With time, I understood that I wasn't paying much attention to my risk management. You could be the most talented trader in the world with a natural eye for investment opportunities and still blow your account with one bad call without proper risk management. So there must be 5 crucial elements in your risk management method. First, the size of your position, and this includes leverage. Second, hedging, meaning taking multiple positions at once in opposite markets. Third, trading during certain hours. Fourth, stop losses and take profit levels. And the last one is knowing when to take losses. Even the best traders in the world suffer a loss at some point. It's part and parcel of trading. The key is to limit your losses to a more manageable level. This way, you will find that you are able to stay in the market for much longer, and this means increasing your chances of having more successful trades in the future. One of the ways that you could strike the right balance between reward and risk is to stick to a reward to risk ratio such as 2-to-1 or even 3-to-1, where your targeted profits are always double that of your maximum losses. So, even if you suffer 3 losing trades, you will only need 2 profitable ones to recover the 3 previous losses if you stick to this reward risk ratio. Although it's not a general rule to follow, but it can help you to visualize a specific approach to risk management. Next, stay disciplined. If you study any successful trader, you won't believe how much discipline they put into their trading. Jesse Livermore once said, without discipline, you would be unable to master your ego, create empowering beliefs, have faith, and develop confidence in your abilities. The lack of discipline will prevent your skill as a trader from progressing. Yeah, we all had those moments where we felt like there's some big chances here, even if my strategy is telling me to stay away, but I'm going to risk it and enter a trade anyway. And most of the times you lose. Even if you win this time by luck, next time there's a big chance you are going to blow your account. So if you don't develop clearly defined trading strategies to follow and follow them consistently, believe me, you will never achieve your trading goals. You may say, what's the harm in abandoning my trading strategy if I'm making a profit anyway? Yeah, making some occasional winning trades, even when you throw your trading strategy out the window, may provide a short-term pleasure, but entering trades randomly can adversely influence your ability to maintain discipline in the long term. The 7th principle is never forget your stop loss. If I would need to list only one trading tool that is absolutely necessary to a trader's success, definitely it would be stop losses. I mean, without them, you shouldn't even think about trading, because if you are serious about a long trading career where your goal is to make money and avoid losing everything, you need to use stop losses in every single trade that you are taking. 8. Keep emotions in check. Jesse Livermore was like a robot. If you study all his trades, you will find out that he will never enter a trade if his strategy is not telling him to do so, and he will never exit a trade without a signal from his strategy. It was crazy how emotionless he was when it comes to trading. And this was one of his main characteristics that helped him make all the success that he made. So remember, your emotions are your enemies when it comes to trading. So when you decide to start trading, don't forget to put your emotions aside, because if you don't, it will only lead you to a long-term loss. Next, be patient. Jesse Livermore waited for the 1929 market crash for more than 4 years. He was a very patient trader. He knew that the market is going to crash, so he kept waiting. Yeah, all he did was waiting for the perfect moment to enter a trade. And by the end of that trade, he made $100 million. So, if you want to succeed in your trading career, you need to be patient. Wait for your strategy to give you the signal. Once you find the perfect moment, don't miss the opportunity. The last principle I learned from studying Jesse Livermore is avoid over-leveraging. Almost all the trading platforms allows you to use leverage. For example, if you have a small capital in your trading account, the broker or the platform can multiply your balance up to 100 times. In other words, he can borrow you money to trade with. Simply, leverage is a financial tool that allows traders to control larger positions in the market with smaller amount of capital. And this can lead to significant profit when the market moves in your favor, but it's dangerous when it moves the other way. So, when you are using leverage to increase your position in the market, be careful, because this can lead to a quick liquidation. Before using leverage, you must have a good strategy and you must know what you're doing. Remember, the higher the leverage, the riskier the trade. So, this is the 10 principles I learned from studying Jesse Livermore, and personally, I think these principles are enough to make you a professional trader. Now, I hope you liked the video. If you did so, please don't forget to like it and subscribe to the channel.